Hello and welcome. Our project is titled AI Driven Acquisition Analysis and Recommendation, identifying the optimal acquisition target using financial risk ratios, ANOVA, and machine learning.
This analysis was completed for MBA 620, Artificial Intelligence for Business, at the University of Indianapolis, spring 2026. I'm Brooke Fallon.
I'm Alexa Berkshire.
And I'm Cindy Kilmark. We'll be walking you through our acquisition recommendation today.
We recommend acquiring Lamb Weston Holdings at an estimated value of approximately $3.12 billion. This decision is based on three key drivers. First, forecasted risk ratios show Lamb Weston maintains stable leverage and the lowest operating volatility. Second, ANOVA testing confirms all 5 risk ratios are statistically significant at a confidence level below 0.05. This means the differences between companies are meaningful, not random. Third, a machine learning model using linear regression produced a valuation of $3.12 billion with only 3.8% error. The two most influential pricing factors were revenue growth and net profit margin.
Key risks include a rising debt to equity ratio, a constrained cash position, and margin pressure. All three are manageable through debt monitoring and liquidity planning. The data is clear. Lamb Weston offers the strongest balance of financial stability, operational predictability, and manageable risk.
Lamb Weston operates in frozen food manufacturing with a market cap of approximately $5.7 billion, headquartered in Idaho.
Utz Brands operates in snack food manufacturing with a market cap between $655 and $700 million, based in Pennsylvania.
Flowers Foods operates in baked goods with a market cap near $1.7 billion, headquartered in Georgia.
These companies were selected because they share similar business models and cost structures. Their financial data also align directly with our Assignment 1 training dataset, allowing for valid AI-driven comparisons.
We evaluated 5 key risk ratios. Financial leverage measures how much of the company is funded by debt. Higher values mean higher financial risk. Debt to equity compares total debt to shareholder equity. A higher ratio signals greater reliance on borrowing. The cash ratio measures liquidity. If it is low, the company may struggle to meet short-term obligations.
Contribution margin shows how much profit remains after variable costs. Lower margins increase risk during revenue declines. Operating leverage measures how sensitive earnings are to sales changes. Higher values mean greater volatility. Together, these ratios provide a complete view of both financial and operational risk.
We now move into quantitative analysis of these ratios. No single ratio can tell the whole story. This acquisition recommendation is built on all 5. All 5 ratios were statistically significant, with p-values below 0.05. This confirms the differences between companies are meaningful.
Contribution margin showed the largest variation with an F statistic above 14,000, confirming fundamentally different cost structures. A stable margin at 0.23 signals predictable profitability across the forecast window. A higher but declining margin introduces uncertainty into acquisition pricing, exactly what an acquirer wants to avoid. Operating leverage differed dramatically. Lamb Weston averaged near 1.8, while competitors ranged from 10 to 90. This confirms Lamb Weston's risk profile is structurally more stable. While the global ANOVA confirms at least one company differs meaningfully, Utz and Flowers Foods show considerable distributional overlap, meaning they may not differ significantly from each other. Lamb Weston is the primary driver of operating leverage effect significance.
Here we see that Lamb Weston has the highest leverage, indicating a greater reliance on debt financing, but improving over time. Utz has the lowest leverage and strongest equity position.
Lamb Weston's debt to equity is highest but trending downward. Flowers Foods remains moderate between both competitors.
Looking at ANOVA's cash ratios, Flowers Foods drops below 0, indicating structural liquidity weakness and requiring immediate working capital intervention following acquisition. Utz maintains the strongest liquidity position. Lamb Weston holds a moderate cash ratio. Liquidity is constrained but stable, not deteriorating.
Lamb Weston has the lowest margin but the most stable. Stability is more valuable than higher but declining margins, as it indicates predictable profitability, which is exactly what an acquirer needs to model post-close performance with confidence.
Lamb Weston maintains the lowest and most stable operating leverage effect, meaning their earnings are dramatically less sensitive to sales changes. Competitors show significantly higher earnings volatility.
Looking at the forecasted financial leverage, we see Lamb Weston's financial leverage stabilizes through 2028, while Flowers Foods shows a slight upward risk trend.
Debt to equity declines and stabilizes for Lamb Weston. UTS remains consistently low.
Looking at the cash ratios, Flowers Foods falls below zero, indicating significant risk. Lamb Weston remains low but stable.
Here we see the contribution margin ratios. Margins remain consistent across all companies, with Lamb Weston showing the most predictable performance.
Looking at operating leverage effect, forecasts show Lamb Weston maintaining the lowest volatility. Competitors remain significantly higher.
We recommend acquiring Lamb Weston Holdings.
The recommended price is $3.12 billion.
This is supported by forecast stability, ANOVA significance, and machine learning results.
We used a linear regression model with grid search tuning. The model achieved 3.8% error. Key drivers were revenue growth and profit margin.
Here we see the risk map analyzing the risks associated with acquiring Lamb Weston. We identified one financial and one business risk.
Here we see our two risks associated with acquiring Lamb Weston broken down further. Financial risk is rising debt to equity. An increased debt load raises financial obligations and reduces flexibility. To mitigate, we suggest structured acquisition financing with debt to equity thresholds, in addition to close monitoring leverage at 12, 24, and 36 months post-close. Business risk is operating leverage sensitivity. While the lowest among peers, its sensitivity is such that a 10% sales drop moves earning by 18%. Both of these risks are manageable through monitoring and cost control and have been priced into the acquisition recommendation.
Looking at the comparative risk analysis, Lamb Weston shows lower volatility than peers, meaning its higher operational structure translates into more stable earnings. Its liquidity remains stable while Flowers Foods declines.
Looking ahead here in the forward-looking risk analysis, we see Lamb Weston maintains the most stable profile across all 5 ratios. UTS operating leverage, on the other hand, is shown to be trending downward, an indicator of earning volatility and a critical warning signal.
Looking here at the risk synthesis framework, Lamb Weston's higher operating leverage relative to its own historical baseline is paired with stable and increasing contribution margins, meaning the operational risk translates into operating income, not operating loss. Stable margins combined with controlled leverage drive consistent performance.
In thinking and reflection and potential implications. For investors, AI-driven ratio analysis provides a faster, more objective way to screen acquisition targets by combining ANOVA testing with machine learning pricing to reduce bias and improve decision confidence. For analysts, ANOVA with Julius AI forecasting reveals statistically significant structural differences, like the 14,437 CMR F statistic, that manual analysis would likely miss, making this rigor both accessible and reproducible. For banks, machine learning-based pricing models create a data-backed anchor for valuation, with low error outputs reducing subjectivity in deal pricing and fairness opinions. AI improves decision-making by reducing bias and increasing accuracy. Limitations include dependence on historical data and exclusions of certain qualitative factors.
We recommend acquiring Lamb Weston Holdings at $3.12 billion.
The decision is supported by statistical significance and forecast stability.
Risks are known, manageable, and priced into the valuation.
The data is clear.
The risk is manageable.
The opportunity is now.
Thank you. We greatly appreciate your time.